Imagine a world where the cost of fuel, the lifeblood of logistics, skyrockets, yet the price to move goods plummets. It sounds like a paradox, a market anomaly that defies economic logic. But for shippers and carriers across North America, this isn't a hypothetical scenario. It's the stark reality unfolding in July 2026. Spot freight rates, the very pulse of the immediate shipping market, are in a freefall across all major equipment types, van, flatbed, and reefer, even as diesel pumps demand ever higher prices. This isn't just a market blip. It's a seismic shift, and understanding its implications is critical for anyone moving goods. Let's cut through the noise and look at the numbers. As of July 2026, dry van spot rates have seen an average decline of 18% year-over-year. Flatbed, often considered a bellwether for industrial activity, is down by a staggering 22%. And even the more specialized reefer market, typically more resilient due to demand for temperature-controlled goods, has softened by 15%. This widespread downturn isn't isolated. It's a consistent trend across all major lanes and regions. Yet, simultaneously, national average diesel prices have surged by over 30% in the same period, pushing operational costs for carriers to historic highs. This is the paradox. Expenses are up, but revenue per load is down. So, how can this be? Why aren't soaring fuel costs translating into higher spot rates? The answer lies in the complex interplay of supply and demand, and a market correction that has been a long time coming. Fuel is a significant component of a carrier's operational cost, often 2, 5, 35% of their total expenses. Logically, as fuel prices rise, carriers need to charge more to remain profitable. However, the spot market is driven by immediate availability and demand, not just cost recovery. The primary driver behind this current rate collapse is a massive oversupply of trucking capacity. The pandemic-era boom, fueled by unprecedented consumer spending on goods and government stimulus, enticed thousands of new carriers, particularly owner-operators, into the market. With relatively easy access to equipment and high rates, capacity flooded in. Now, as that demand normalizes, and in some sectors even retracts, there are simply far more trucks available than there are loads to move. Think of it like a crowded auction where everyone is desperate to sell, but few are eager to buy. Compounding this oversupply is a significant softening of freight demand. Economic headwinds, including persistent inflation, rising interest rates, and a general tightening of consumer spending, are leading to reduced manufacturing output and slower retail sales. Many businesses, having overstocked during the supply chain chaos of recent years, are now sitting on bloated inventories, reducing their need for new shipments. This decreased demand, combined with the abundance of available trucks, creates a buyer's market where shippers have immense leverage, driving down spot rates. This creates what's known as a margin squeeze for carriers. They are facing a double whammy: dramatically increased fuel costs on one side, and significantly reduced revenue per load on the other. For many, particularly smaller owner-operators who operate with tighter margins and less negotiating power, this situation is unsustainable. We're already seeing a rise in carrier bankruptcies and owner-operators exiting the market. While this might seem beneficial for shippers in the short term due to lower rates, it's a dangerous game. A widespread collapse of carrier capacity could lead to future shortages and even higher rates once demand rebounds. For shippers, this paradoxical market presents both opportunities and significant risks. On the surface, lower spot rates translate to immediate savings on transportation costs. However, relying too heavily on the spot market without a strategic approach can be a perilous path. The immediate concern is how these fluctuating costs impact your freight budget. Traditional budgeting models often factor in a certain percentage for fuel surcharges, but the current environment demands a more dynamic approach. The savings on the base rate might be offset or even overshadowed by the escalating fuel costs if not managed carefully. Your budget needs to account for the total landed cost, not just the per-mile rate. So, what should shippers do to protect themselves from this margin squeeze and navigate this volatile landscape? The first, and perhaps most critical, strategy is proactive contract renegotiation and benchmarking. If you're primarily relying on contract rates, now is the time to review those agreements. The dramatic drop in spot rates provides powerful leverage. Use current market data to benchmark your existing contract rates against the prevailing spot and contract averages. Don't wait for your annual review. Initiate discussions with your core carriers now. Aim for more favorable base rates or explore index-based contract structures that automatically adjust with market conditions, but ensure these indices reflect the current reality, not just past trends. Secondly, diversify your carrier relationships and cultivate strong partnerships. While the temptation might be to chase the absolute lowest rate on the spot market, remember the long-term implications. Building strong, mutually beneficial relationships with a diverse portfolio of reliable carriers is crucial. This provides flexibility and resilience. Consider offering guaranteed volumes or longer-term commitments to preferred carriers in exchange for more stable, favorable rates. This can help them weather the current storm, ensuring they're still around when you need them most, and potentially securing capacity when the market inevitably tightens again. Third, leverage technology for enhanced visibility and optimization. Modern transportation management systems, or TMS platforms, are no longer just about booking loads. They offer sophisticated analytics, real-time tracking, and scenario planning tools. Use these platforms to analyze your lane data, identify inefficiencies, and optimize load consolidation. Real-time visibility into your shipments allows you to react quickly to delays or disruptions, minimizing their impact. Furthermore, advanced analytics can help you predict future rate movements and adjust your strategy accordingly, moving beyond reactive decision-making. Fourth, thoroughly understand and utilize fuel surcharge mechanisms. While fuel costs are rising, many contract rates include a fuel surcharge linked to an industry average, like the Department of Energy's weekly diesel price. Ensure your contracts have transparent and fair fuel surcharge clauses. Review how these surcharges are calculated and applied. In a market where base rates are low but fuel is high, the fuel surcharge can become a significant portion of your total freight bill. Negotiate for favorable fuel surcharge tables that accurately reflect market conditions without disproportionately burdening your budget. Looking beyond the immediate crisis, shippers need to focus on long-term planning and building resilience into their supply chains. This means not just reacting to current market conditions, but anticipating future shifts. Consider nearshoring or reshoring strategies to reduce transit times and dependence on long-haul trucking. Explore intermodal options where feasible, as rail can offer a more stable cost structure and reduce reliance on over-the-road trucking for certain lanes. Invest in robust inventory management practices to avoid the overstocking cycles that contribute to demand volatility. The current market paradox of falling spot rates amidst surging diesel prices in July 2026 is a challenging environment for all involved in freight. For shippers, it's an imperative to move beyond simply enjoying lower rates and to instead embrace a proactive, strategic approach. By renegotiating contracts, diversifying carrier relationships, leveraging technology, and meticulously managing fuel surcharges, you can not only protect your margins, but also build a more resilient and cost-effective supply chain for the future. Agility and strategic action are not just buzzwords. They are the keys to thriving in this unpredictable landscape.